Chaos is coming. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, markets are on the brink as the unthinkable nears, and we talk about the unthinkable. We're not talking about a no landing or soft landing scenario. We're talking about an economic scenario that sparks fear in the hearts of central bankers because it's one they are powerless to stop. And when you see how this is going to impact the equity markets, the bond markets, then you'll understand why chaos is coming in the near future. And there's absolutely nothing the Fed or any central banker can do to stop it. Now, let's go to Bloomberg, where we picked today's story up with a headline: U.S. economy slows and inflation jumps, dampening soft landing hopes. And this is indeed the worst case scenario for the economy, is where you get rising inflation and slowing demand, because then all of a sudden you start to see all these parallels to the 1970s when the economy slowed and inflation rose, and that left central bankers with only one move, and that is to continue raising rates until they crash the economy repeatedly to bring inflation down. And this isn't something anyone wants, not even the Fed. But things have changed a lot, and now all of a sudden we're going to find out that the economy doesn't need more rate hikes. It's going to need the Fed to do something it doesn't want to do. As U.S. economic growth slid to an almost two-year low last quarter, while inflation jumped to uncomfortable levels, interrupting a run of strong demand and muted price pressures that have fueled optimism for a soft landing. And we noted that this was unlikely to happen because when you see inflation cooling off, it tells you demand is going down. So as inflation slows, it's no surprise that we see GDP decline and economic growth turn down. This makes perfect sense because here you see gross domestic product increase at a rate of 1.6% annualized, well below every economist's forecast. The government's initial estimates showed that a wider trade deficit subtracted the most from the growth since 2022. In fact, the main growth engine, personal spending, rose at a slower than forecast 2.5%. And when you start to put the pieces of the puzzle together, it makes perfect sense. Why was inflation slowing? Well, wage growth and compensation was slowing against higher prices. And we've made the case repeatedly on the show that consumers were not in a position to afford higher prices. They would reject this and eventually would start showing up in the economic data. And now we're seeing it today. And a closely watched measure of underlying inflation advances a greater than expected 3.7% clip, the first quarterly acceleration in a year. And largely, of course, we note this is due to the increase in energy prices, but that is only part of the problem because now we face an economy that is slowing, consumers unable to afford higher prices, and that is devastating news because you start to understand the Fed needs to cut rates here. They don't want to. They're really adamant about bringing inflation down. The problem is they're going to take the entire economy down and inflation with it, as figures represent a notable loss of momentum at the start of 2024 after the economy wrapped up a surprisingly strong year. And we noted that that happened due to a massive expansion in credit. Many people believed into the rhetoric that we heard from the political elites and the central elites that yes, the economy was going to boom and consumers went out and spent big. And guess what? It did not turn into economic prosperity. It didn't work at all. And with the inflation pickup, Federal Reserve policymakers who were already expected to hold interest rates at two-decade high when they meet next week, this is likely not going to change their perspective, may face renewed pressure to further delay any cuts and to even consider whether borrowing costs are high enough. In fact, expectations now are being pushed back to December in terms of the first cut. The reality is we see the economy slow, something devastating is going to happen. This is why we're going to look at what's going to happen to the equity markets and the bond markets, because what we're going to see is all-out chaos, and that will indeed bring the Fed to its knees. And here we can see what's happening in this chart, the real gross domestic product in blue against the consumer price index in red, and both on a year-over-year rate of change. And we can note that we've seen cases where inflation has risen against a decline in economic prosperity. That is simply telling us that consumers cannot afford those higher prices, the economy slows, and what eventually happens exactly what we would predict. Inflation comes down because demand drops. And you see that happen each and every time, but with a lag. So what happens right now is we get caught in this bubble that everyone believes we're facing a stagflationary period, that maybe it's permanent now, maybe it'll lead to a recession, maybe something else, maybe we'll see a resurgence in inflation. But the reality is, as we move into more of a global economy, as you get into the 80s, what you see is a slowdown in economic growth, leads to eventually a collapse in the consumer price index, and then of course, you don't see a resurgence of inflation. In fact, you really don't see that happen at all. And you see this relationship over and over. So as we see GDP roll over and head down, we could see inflation push a little higher. But as demand starts to fall apart, well, the next thing you know, inflation's going to come down in a big way. But that's not the only problem the economy is facing. While collapsing the U.S. economy is just what soft landers wanted, a huge GDP miss was just half the story, because at the same time, the BEA reported the GDP deflator, the price index, came in at 3.1%, hotter than the 3% expected. Worse, the all-important core personal consumption expenditures for Q1 soared from 2% to 3.7%, blowing away the estimates, suggesting the U.S. economy is not only going to not pass go and overshoot the soft landing island completely, it's according to Zero Hedge, but crash land straight into a stagflationary recession. And that is absolutely correct. That is indeed what's going to happen. And for many people, this is going to be devastating for their biggest asset, their 401ks, their retirement accounts, their IRA rollers. And you're saying, Steve, how can I protect myself? I said, well, my friends, we give you the tools. You know, many people say, okay, look, your tools are great at finding bottoms. Do they predict the tops? Yes, they do. They work both directions. And look, you don't have to be a trader to use a report. We show you when you start to see the machines going negative, that's a time to start cutting positions on your biggest asset and protect it. When momentum starts to shift in a meaningful way, take money off the table and eventually look to go to cash. We give you these tools. Now, you can trade with them if you like to, but can you imagine keeping intact your biggest asset and knowing when to go long and with your 401k? That is the tools we give you. Think of this as not just a trading tool, but portfolio insurance for your biggest asset. We have two reports, CTA Time Pro. We look at the machine positioning, but what the machines don't do that we do is we run a historical overlay. We often lead their positioning in a big way. We give you the heads up ahead of time, and then we show you momentum. When the market turns up or down, you put the two together, you know when to take your biggest asset, start raising cash, or go long. We give you the tools. It'll save you a ton of money in the end. And guess what? There are links in the description for a 30-day free trial. You owe it to yourself to look at this, protect your money, because as you're seeing, our reports were spot on. And commenting on the reports, not ours, but Fitch writes, the hot inflation print is the real story in this report. If growth continues to slowly decelerate, which it will, I'm going to make the case this is going to happen, but inflation strongly takes off again, highly unlikely, because when you see demand go down, eventually inflation follows. And inflation is heavily driven by the energy market. So what happens as consumers cut back their spending, what you start to see is demand for energy falls. Can we get a scenario like we did going into the global financial crisis where energy outright surges? Yes, we can, but it won't last. That's the key thing here. The expectation of a Fed interest rate cut in 2024 is starting to look increasingly more out of reach. Well, the reality is the Fed is going to cut because demand is going to come down. We'll make that case later in the show, but let's take a look at why we see what's happening is going to lead not just to a stagflationary recession, but an all-out recession where inflation goes away. And you can see when we overlay total compensation shown in green, which is average hourly earnings of production and non-supervisory employees, multiplied by average weekly hours. Again, that's shown on a year-over-year rate of change. So what happens here is you see inflation rising and the economy slowing. That's telling us consumers aren't able to keep up with those price increases. And sure enough, what it is matched with is a deceleration in total compensation, validating what we know. That leads to a decline in demand and ultimately a crash in the consumer price index. Now let's fast forward here to the dot-com bubble. We see the same relationship. Inflation rising faster than wages, and then all of a sudden, economic activity starts to fall, wage growth slows, and next thing you know, inflation follows it down. The same thing here in the global financial crisis. Again, GDP growth slowing down, inflation rising, stagflation alarms going off like crazy, wage growth slows, consumers again can't keep up with it, inflation comes crashing down. Same scenario here, and we note that of course some reports in those PMIs are suggesting that average hourly earnings are coming back to the long-term average if that were to happen. And we'll find out soon enough. What that means is, of course, the notion that we're going to see a long period of stagflation is unlikely. It's going to lead to one of the biggest problems both the Fed and nor the Biden administration can handle, and it will lead to an acceleration of Fed rate cuts. Not what the market's predicting at the end of the year, but what we'll see is cuts come sooner, because what then happens during these periods where you see rising inflation and decreasing demand as shown by the GDP, well, you need fewer employees. And now when we start to overlay continued unemployment claims, what do you see? A perfect track record of recessions. You want to know how they happen? It's simple. You see inflation rising, consumers can't keep up with it, economic activity slows, more people hit the unemployment line, and you see 1, 2, 3, 4, 5, 6, 7 times in a row. This happens, actually 8 because I didn't highlight this one. You see this activity happen over and over again. So what we're looking at now is just a matter of how long does the labor market hold up. Now, in the show the other day, we talked about Tesla laying off, and some people comment, Steve, you just don't understand Tesla. You know what? You might be right. But what I do understand is manufacturing, inventory, and sales. And when you manufacture a bunch of products and build up your inventory, and nobody buys it, well, you don't need to keep building products, and you certainly don't need people to build them. And that's exactly what Whirlpool is saying today. As Whirlpool is cutting 1,000 jobs as the U.S. appliance demand remains stagnant, that's not what you want to hear, because they're cutting, and this is a problem. The company has completed its first wave of layoffs as office staff is planning to start another soon, this according to the chief financial officer. Earlier this year, the company said it was cutting jobs without saying how many, and at the end of last year employed 59,000 people worldwide. The discretionary side that's driven by existing home sales really has seen no pickup and no benefit yet. We're simplifying our structure, and that's something you're going to hear a lot of companies do. We see that happening with Tesla. We see that now happening with Whirlpool. We hear that with other companies. Remember, there was a first round of layoffs, and we said, watch out, there's going to be a second round. But you know who doesn't actually believe that? Well, it's the government, because when we look at the weekly unemployment claims, which are probably largely not reflecting that many of these people are getting some form of severance package, initial unemployment claims remain at a very low level, now dropping to 207,000. And now look at this, continued claims dropping from roughly 1.8 million down to 1.781 million people. So only the question is, where are these jobs coming from? Well, we happen to get an idea of that, but is the unemployment claim data going to stay low for long? Well, Tesla issued what's called WARN notice, or Worker Adjustment and Retraining Notification Act notices, and we can see here on this one, when we look at challenger job cuts, these are large corporate cuts, and WARN notices, what you see is the government reporting virtually nobody's filing for unemployment claims. At some point, that is going to change in a meaningful way, because workers who are receiving severance, well, they don't file for unemployment until after the severance is up. But the question then remains is, if we continue to see the non-farm payroll numbers rising, or at least looking fairly strong in the eyes of the Fed, what kind of jobs are we creating? Because the economy shouldn't be slowing here. And what we're seeing is a transition out of white-collar job as it growth stalls, even in the pandemic boom towns. This is dangerous news. And nationally, payrolls for white-collar jobs were up just 0.6% from a year ago in March, about a third of the overall pace of job creation. Wage growth for high-paid workers is also largely cooled from its peak. And again, that's important, because what it says, not even they're keeping up with inflation and their expenses. That means a less demand. And that all comes back to discretionary spending, which is key here. As consumers cut back on the discretionary side, well, it leads to fewer hours being worked, fewer jobs needed, and next thing you know, eventually more unemployment claims that the government eventually has to admit. And part of the weakness in white-collar sectors is a result of a sizable pullback in the BLS subcategory called temporary help employment, which is regarded as something of an economic bellwether. That's because when times get tough, businesses tend to shed part-time positions before full-time ones. More than 420,000 of those jobs have vanished since the sector peaked 2 years ago. So where are we seeing the job growth? Well, mainly in low-wage jobs. That is a challenge because that isn't what the economy needs right now. So what does all this mean? When we talk about a stagflationary recession, what does it mean for the equity markets, the bond markets, and what is going to break everything to get the Fed to cut? Well, let's take a look. Because stocks get hit after GDP goes the wrong way, and that means chaos is indeed coming. Because when we look at the markets, what is everyone in? They're long the U.S. equity market, and not just U.S. investors. We're seeing investors all over the world. Even worse, they're long about 6 or 7 stocks. Everybody is crammed into the same ones. And when you look at this condition, when we get into these kind of stagflationary periods that we know are going to break, and you see here GDP growth slowing as economic activity slows and consumer prices rising, everybody right now is still super bullish on the equity market. You see them, let's take this thing to all-time highs. This is a pullback. Let's buy. That's what they're thinking. What happens? Indeed, the U.S. equity market comes crumbling down every time. You want to know what to buy? Sign up for our reports. We'll show you what to do. We'll show you how to hedge your risk. We'll show you how to make money even in a down market. Because look at this. U.S. yields rose today too as traders see Fed delaying the first cut till December. Of course, we know they're going to cut long before that. And how do we know? Because when you look at the same condition, you do get this bump higher in yields. As the market says, well, the Fed's got to raise rates because inflation's going crazy. And the next thing you know, rates go on a downward tear. That means bond prices go up in a meaningful way. And why does that happen? Well, it's quite simple because yields are a function of growth and inflation expectations. The market gets fixated on inflation, the economy starts slowing, and the next thing you know, everyone starts to figure out that you don't get inflation in a period of slowing demand. It doesn't work. Yields come tumbling down. There is your insight. We give you the tools and the macro view on how to keep control of your biggest asset and make money at it. Check out those links in the description below because it's the dollar that's going to wreck everything. Right now, it's forcing investors to seek cover in exports in other parts of the world. We flag that in our reports today too. But let's talk about the dollar here because what happens, and we're going to use a Japanese yen to US dollar spot rate just because it has more data than the actual dollar data in the Fed database. But what we can know is when you see periods of decelerating US economic activity against rising inflation, the dollar tends to rally because you see this is creating a dollar shortage. People start moving into the dollar. You see that happen here in the dot-com bubble. You see it in the global financial crisis, a bit of a rally in the dollar. And what happens after the dollar comes down? Dollar comes down, dollar comes down. Now the dollar's rallying. It's going to break this whole thing. That inflation story in the U.S., the dollar is going to take care of that. And what does that mean for the Fed? Well, it means they're going to cut, and not by December. They're going to cut far sooner than that because if economic activity continues to slow and the labor market goes, the Fed knows that inflation is a foregone conclusion. It will come tumbling down. And sure enough, you can see going back into the 90s, the Fed was cutting in a stagflationary period. They were cutting again during the dot-com bubble stagflationary period. They did it again during the global financial crisis. They're going to next week say they're not going to do it. They're going to tell us, you watch and see. The Fed will tell us we probably need to keep rates higher. We may even need to raise them. And the next thing you know, in a matter of months, when the labor market data finally reflects the reality of what we're seeing, the Fed will cut too. And then, as you're about to find out, all chaos in the equity markets will resume. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.